Hello, this is Bob Steele. In this lecture, we will continue on Chapter 12. We'll be talking about dividing income or a loss within a partnership. So now we have the partnership, it's up and running, we've started it, and we now are allocating the income and or loss that we have generated over time periods, hopefully income. So dividing income or loss. Partners are not employees of the partnership, but are its owners. This means there are no salaries reported as expense on the income statement. Profit or losses of a partnership are divided on some agreed upon ratio. So the idea being that if we're partners in the partnership, obviously we do a lot of the work in the partnership, but the partnership is basically a flow-through entity. So the income we earn are basically going to be as partners. We're not generally going to file a W-2 form and whatnot for the work that we do within the partnership. We're going to divvy up the net income between us, and that's how we'll allocate the revenue and the income. So 3 frequently used methods to divide income or loss are allocated. We could use a straight ratio. So the most basic ratio would be a 50-50 ratio, but we can choose any ratio. And again, this is the flexibility within the partnership, that we could have a partner that does more than the other partner, and that's fine. Again, there's nothing wrong with an agreement like that. But both partners we want to make happy. We want to make both partners feel that whatever agreement that is agreed upon, it is fair. So we could have a different allocation of the net income. We can also have a capital balance type of allocation, meaning that we're going to give a return on investment based on how much that partner put into the partnership as of the beginning of the year. Once again, that seems reasonable in a lot of areas. Services, capital, and stated ratio. We could have a combination of these 3 items. We could apply basically a flat rate, which would be similar to kind of salary. We would say, well, this person works this many hours, maybe we're just going to apply them a flat rate per year or month or whatever, and then we'll apply a ratio based on top of that. So let's see how these play out. Allocation on stated ratio. So the most basic thing to do with net income, and remember what we're saying here is, in the partnership agreement, Zane is to receive 2/3 and Perez 1/3 of the partnership income. So of course that adds up to 3/3 or 100%. If the partnership income is $60,000, we will allocate the income to the partners as follows. So remember, what we're doing is saying they did business, they earned $60,000, let's say in a year, and now we're trying to figure out how to split it. If they were even partners, we would split it 50-50, meaning income summary means that we're basically closing out the income, the whole income statement, putting it into that income summary account. So the income summary means basically net income. We're closing out the income statement and taking it out of income summary. We're putting it into the capital account, increasing the capital accounts for the amount that basically we are allocating to the owners, which basically increases the amount that the company or the partnership in this case basically owes to the owners. If we're going to do this in a calculator, notice the ratios are a little bit more precise than a percent sometimes. For example, if I took 2 divided by 3, it's 0.6666. It's not an even number. That's why we have to use ratios sometimes. So if we were going to allocate this, of course, it would be 60,000 times 2 divided by 3. And we can get the allocation. So we would allocate it out 40-20 in this case. So that would be a fairly simple allocation method. And of course, the assumption here is that for whatever reason we agreed upon, Zane is getting the larger allocation here. So allocation on capital balances. In the initial partnership agreement, Zane and Perez agree to allocate profits and losses on the basis of their beginning balances. So this is another one. Again, it seems reasonable in a lot of areas. You don't have to do it this way, but this is another way that the allocation method could work. And the idea here is that we look at their capital balances, meaning kind of what the individuals, the partners have invested into the company. That adds up to 40,000. 30,000 over 40,000 means you have the 75%, and the 10 over the 40 is the 25%. Therefore, if we take this allocation, we could allocate it out. The 60 times the 75 would give us the 45. The 25 times the 60 would give us the 15. We can allocate in proportion to the capital balances. So that would be another way to allocate. Once again, the net income is represented by the income summary account. So if you see that in the book, remember in Chapter 4, we close out the income statement to the income summary. Then we close out the income summary to the capital account. So basically, we're making net income 0. we're allocating net income to first the income summary, then to the capital accounts, which is where they ultimately will go. So allocation on services, capital, and stated ratio. So Zane and Perez have a partnership agreement with the following conditions. So Zane services a $36,000 annual salary allowance, and Perez receives an allowance of $24,000. Now we call this services and we call this a salary allowance, but in a partnership, notice we're not going to issue a W-2 on this. We're not going to have it be part of payroll, but we're going to allocate this lump sum based on the idea that it's kind of like a salary. So it's still going to be a distribution, even though we're using this term as a salary allowance. It's not a W-2 salary, so keep those two things separate in your head. It's just a way that we're going to help us allocate. Each partner is allocated an annual interest allowance, 10% on their beginning balance, and any remaining balance of income or loss is allocated equally. So what if we had $70,000 of income? So we have net income of $70,000. We're going to use this fairly complex allocation ratio, which again is really can only do this in a partnership type of agreement, which is why they can be very useful in some areas. So we're saying there's a net income of $70,000. First thing we're going to do is we agreed we're just going to give 36 and 24 off the bat, off the top, no matter what the net income is. Then what we're going to do is we're going to allocate based on their investment in the capital accounts. So we're going to take the beginning capital accounts at the beginning of the year, which was 30, and we said we're just going to allocate 10%. We're going to give a 10% return on investment, basically allocating the net income based on a 10% return in the capital account on the investment, which comes out to 3 and 1. Then we're going to allocate the rest evenly. So that means that this is basically a plug. So what we're saying is, what do we need an even allocation here in order to get to the 70,000? So, we could think of it as adding these up, having the 70 minus the 36 minus the 24 minus the 3 minus the 1 would give us 6,000 divided by 2, or times 50%, would give us an even distribution. So that would give us the 42 and the 28, which would add up to the 7. So this is a fairly complex kind of allocation structure, but it could be useful for us to allocate it in that way and come to a specific agreement that we can both agree on. Now, you might be thinking, well, what if we didn't make 70? What if we made only 50? Well, that could be a problem, and we need to take that into consideration if we come up with a complex allocation like this, because we would still have our salary. Remember, these are fixed numbers, so of the 50, we're allocating 36 and 23 based on just a set allocation we agreed upon. Then we're doing the same allocation with the 3 and the 1 based on our beginning capital balances. But now if I took the 50 minus the 36 minus the 27 minus the 3 minus the 1, we're coming out to a 14 deficit, meaning we didn't make enough income to cover both our salary and our interest allocation methods. Therefore, we got this 14 negative that we have to allocate evenly. So that could come out to be unfavorable to partners, and partners basically need to keep that into consideration. What if the company doesn't make enough money to allocate out, and we then said that the rest would be allocated evenly? Now we're allocating a negative number, so the 36 plus the 3 minus the 7, and that needs to be taken into consideration when we come up with these partnership agreements.